Hello and welcome to the show. We're joined today by Mark Selby and also Dave Lotan. We're going to ask the question today is how should you, could you, can you value companies before you place your hard-earned capital in there? So first of all, good morning, gentlemen. How are you?
Very good.
Hey, Matthew. How you doing?
All good, Dave. All good, Dave. I'm excited, actually, because what we're going to try and do is kind of strip back and simplify for investors a process, or maybe a few different ways of looking at companies when you're trying to evaluate them. We talk a lot about doing fundamental analysis, and I'm not quite sure everyone totally understands what that means. So I'm just going to ask a real simple question of both of you. I'll start with you, Dave. When you're looking to invest capital into a company, what do you look for?
Well, the very first thing that I look for, Matthew, is who's going to buy it from me. I don't want to buy anything where I don't have a strong suspicion of who the ultimate client is, and I want to have a pretty good estimate on what their buying power is. So, using gold as an example, I think that the buying capacity of the industry right now is a function of the market cap of the big and the mid-sized companies. Probably have about $250 million worth of market cap at the big companies right now. Maybe 20% of that market cap at most is available for investing. And if you knock out the Chinese companies who aren't well received in some jurisdictions and the royalty companies, that number goes down pretty dramatically. So 20% of that balance is adjusted for the royalty companies and companies that aren't likely to be buyers. Is about $40 billion. But when I look at that cohort, I think maybe Goldfields is still a buyer. Maybe Northern Star would buy something. Kinross. So among the major gold producers, 1.5 million ounces or more, maybe there's $7 billion total of buying power right now. And the maximum transaction size I see is maybe Goldfields could tuck in something for $2.5 billion. From there, it drops really, really dramatically and really quickly. You're talking about Endeavor, Alamos, B2, all of which that could maybe manage $1 billion acquisition at most, assuming 20% is sort of the limit that they want to go to. So if someone tells you their company is undervalued, those are the maximum sizes of transaction that really are available for majors or mid-tiers at the moment.
Right, so there's not a lot of money around, and there's certainly not a lot of new money around either. Looking in here in the gold space, does that change any, Mark, when you're looking at some of the base metals, some of the battery metals?
No, it's even more so. Dave makes a fantastic point. All private equity guys, when they make a deal, when they buy something, they've always already thought through what the exit's going to be. And if they can't see a clear path to an exit, they don't make the acquisition. So, as investors in junior mining, you really do need to think who's going to buy it. And, the reality was 30 years ago, you might have had 3 or 4 tiers of buyers. There was this kind of nice food chain where, companies that were smaller size could actually buy small scale development projects and get them funded. The reality today is, as Dave said, you've got this very small top slice at the very top of the food chain, and they're the only ones who've got enough firepower to actually buy anything underneath. So, think through that for sure. And then, to Dave's point in terms of pool of capital, now, Lithium's obviously expanded, and we're talking a few days after, as Azure just got this bid on a no resource X drill holes to pretty nice lithium drill holes. But, other than that, there's still not necessarily a huge amount of capital in the space. And as you get, away from gold, silver, copper, the amount of capital, shrinks very, very, very quickly. So if you're in an obscure mineral, it's very tough to think that, there might be somebody on the other side to actually buy this transaction. And then you have to be confident the team running it, in that case, actually can build it. Because otherwise, you're never going to see a path to cash flow.
Right, but Dave, what you say it's important. That's one of the first things you looked at. Who's going to buy this thing, right? Why is that important? We see lots of exploration codes who are so far away from being in a position to put themselves for Azure's an extreme case. I think we can discount it, where pre-resource or pre-economic study, that's where retail like to hang out, where they like to play. The last question they're asking themselves surely is who's going to buy this thing.
Yeah, I think at their peril. And I mean, lithium's a very interesting example right now. 5 years ago, I sat in a presentation at PDAC where a very famous investment pundit talked about how the lithium industry was a mirage. Albemarle and SQM were going to dominate the industry. They had 100 years of resources each. They would never buy anything. And here we are 5 years later, and all of the brines have been cleaned out in Argentina by Ganfeng and a couple of other Chinese actors. And now we've gone to pegmatites. And the best pegmatite resources in the world are quickly being cleaned up by SQM, Albemarle, and Rio Tinto is out there doing multi-decamillion-dollar joint ventures around lithium. So it's a great example of how quickly things can change. And as we discussed off screen, it's a sector that has chaos actors in it. Gina Reinhardt deciding to foil Albemarle's bid for Liontown, and who knows what she's doing in relation to the Azure bid. But it's a very interesting space, and it's an example of how quickly things can change. So you might, if you were buying lithium 6 or 7 years ago, have had to have quite an imagination to see this coming. But there's nothing like government policy, trillion-dollar legislation like the Inflation Reduction Act to change things in a real hurry. I don't necessarily see those things happening outside the battery metal sector. So if you're trying to imagine a world where your gold company is going to get a $2 billion bid, I'm not sure where that's coming from. But I suppose good things do come out of seemingly nowhere, as lithium illustrates.
Yeah, I think on that part, in terms of why you want a buyer, it's markets like today. We've gone through almost sort of 3 years now of really horrible equity markets, and at the end, what helps keep your asset from becoming a zero, or you basically having to say, look, I'm down 80% over a 2 year period. I got to take my money out because I got to go buy groceries. Is the fact that you may have an acquirer come in and actually take that asset. Lithium's a great example. I mean, right now, so many people it's got lithium in its name. Something pops up, it's quote new, but you might as well go to the horse track and bet on a horse with lithium in the name, because at least one of those 9 are going to win the race. In the junior mining space, there might be 500 people, and none of them end up winning. And now lithium, again, as a commodity analyst, like there are times where you get this real secular shift in a commodity. But if you're going to make that bet, you have to really do the work to do it. And again, if you really do the work, then you can get it, you can figure it out. Like in 2019, early 2020, 2 years after David said this guy stood up. Yeah, that's what the market looked like. Lithium was, most of the companies that had started to develop stuff were nearly bankrupt. But if you did the work on lithium as a commodity, you go, oh, like there's no way all the supply is going to come online in time to be able to meet this demand. But unless you're prepared to really do the work on the commodity, like those shifts come along once in a decade, and you got to do the work to be able to pick it properly. Again, otherwise you're just throwing money in the shredder. Like that's that's the caution there.
Those are quite hard things for people to actually verify and validate, though, in terms of, if you lithium example, to look at those two major producers. How quickly could they turn the taps? I remember it was a JP Morgan report that actually said it, I think, and that they can sate the world's demand for this in perpetuity. But the reality was that takes money and time, even for existing producers. So that's hard to get at. So apart from can it be bought and who's going to buy it, how else do you look at these things, Dave? Let's stick down at the exploration side of the things, where it's a bit early days. It's even a bit hard to answer the question down there as to, can this thing be bought? Because you don't really know what you've got. So what do you look at?
I think of the exploration cohort as one giant science experiment. So I look at what's on the venture and what's on the ASX, and I suppose I missed Great Land Gold because they were on the AIM, which is an exchange that I think is not well served by liquidity for gold exploration, anyways. And I think about what the context looks like. So right now the venture's at 520. It bottomed in 2015 after a long bear market at about 470. It would seem like we're very close to minimum capital availability for that space, and therefore the constituents within the TSXV are probably close to their bottom. It's a completely capital flow driven industry, and given that I think the total market cap of mining companies on the venture right now is something like $30 billion, and that's 1,000 companies. It's not a big market cap between them, and obviously that's smaller than the market cap of any major producer. Now, most of those companies are garbage, but within the 1,000 or so companies, there are 100 companies that either have good people who want to make discoveries, who maybe have discoveries in progress, or maybe they're not even great people, but they have a discovery. And so right now I feel pretty aggressive about buying these companies because I think we're at a low in capital available to the industry. And over time, capital has always flowed back into this industry, the R&D section of it, I should say. And one of the reasons is 65% of deposits currently being mined today were discovered by juniors. So the sector, even though it produces a lot of zeros, over history has demonstrated its utility, and it's a stock picker's market. So stock picking's out of favor. That's a bit of a problem. There isn't a lot of stock picking capital available for the business, but it doesn't require much capital actually to light the fire.
It doesn't. And I guess I immediately go to thinking about if I'm a retail guy and I'm looking at all of this choice, you said I would say it's 70, 80% garbage, right? I don't think that would be harsh. But for average retail looking at all of these companies, all pretty much saying the same thing and all pretty much roughly in the same position, it's hard to work out who's who at the zoo. So again, if you're looking in, what are the either assets, variables that you're looking for? What defines a good management team? What are the ratios that you need to see? Do you say it's a fool's errand to rush in before there's a resource or even an economic study in this thing? I mean, how would you look at it, Mark?
Yeah, I think I think the key thing is of that 1,000 companies, 950 of them aren't so good. So the first part is has the management team actually ever discovered anything and taken it, beyond one or two drill holes? That's number one, right? Then number two is, have they have a proven track record of actually raising enough capital to get it to the point where it's an advanced exploration target or to get to a resource? Because again, that takes $10 or $20 million. And if they go through that list of companies, there aren't many people who've been able to raise $10 or $20 million. And so, all of a sudden, if that gets sort of 2/3 of what's there, then you can start looking at the targets themselves. And again, what most of the crappy companies do is they grab some asset that's been looked at through 3 nickel booms or 3 gold booms. It got partway there, and then they drill a hole really close to the last really good intersection that's been drilled historically, and talk about, where they hit 5 grams over 10 meters. And so you need to look to say, okay, is this a brand new discovery, or is this a team that has an old asset and can effectively communicate, there's a new theory here in terms of why these deposits, could hold a bigger resource. Again, a Cisco with thinking that all these high grade gold mines in Quebec that had been mined for 70 years, there's actually this giant low grade deposit sitting around it that actually has way more ounces than was ever mined, from these individual high-grade mines. They need to have a theory as to what's going to be different this time, and again, with enough technical expertise to actually be able to be able to deliver it. If you just use those 3 filters, that will literally get rid of 80% of what's there, and then you can actually start looking at what was there. I don't date what you spend a lot more time than I do looking at in investing around across companies. And you've been good at it. So
investing in the red light district of the sector, yes, for sure. Well, it's just to pick a couple of enduring themes. So Cisco is a great example. The Malartic region had hosted, let's say, probably 10 or 20 little high-grade operations over the years. Bob Wares, John Brzezinski, and Sean Rusin had a theory that you could turn the whole thing into a super pit, essentially, and mine it in the way that these giant super pits were being mined in Africa, provided that when you drilled between these old mines, there was gold in between. First, they had to unite the land package, which took several years. They wanted some of the old historical tailings to go back to the province and get sterilized and come out without environmental liabilities. Some of that went into a lottery. They had to buy that from Glenn Mullen and Jack Stock. But eventually they put the package together. They had a great theory on the package. It needed to be proven, and it was. And then all they had to do was move a town, which was, I guess, easier than many of us thought it would be. Raise $1 billion and get it up and running and commissioned, and they did. That will happen in every cycle. Somebody will take a land package that was somehow disassembled, put it back together, apply new thinking to an old district, and make you a bunch of money. But it will maybe happen for 1 in 1,000 companies. And using Mark and I guess Martin Tureen at FPX as an example, big low-grade nickel occurrences suddenly brought into value because of the rush for battery metals and the scarcity of nickel resources. And then this sort of green swan where, I guess, is it magnesium in the tailings that allows you to sequester carbon, Mark? I'm not sure exactly and carbon sequestration will be right. Carbon sequestration will be critical if we're going to keep this net zero facade going. It's not going to happen without A, mass nuclear adoption, and B, carbon sequestration technology. So that's taken some of these nickel projects, which generate this mineral in their tailings, and change the ball game for them. So those are things that not every investor can figure out. But that's why it's a stock picker's market.
But let's come back to something you said though, Dave, and Mark, you can pick up on this as well if you want. I think you were effectively saying a few minutes ago that we're at or near bottom, in your opinion. Is that? I don't want to put words in your mouth. Is that what you're thinking?
The larger context for me is that assuming that I want to buy when flows are low and sell when flows are high, flows are low.
Okay, right. So therefore, I think what's interesting, and so we've had conversations in the uranium space at the moment. I guess the only kind of green shoots that seem to be around at the moment, it feels like. But I spoke to like 3 different fund managers. They're all saying you've got generalists looking into the space, but they don't understand the vocabulary, the language, or the narrative, or the supply-demand fundamentals. But they're trying to learn because they kind of feel there's a bigger macro thematic here in terms of energy transition and baseload and all of that kind of good stuff as renewables fall slightly out of favor. And those generalists, any one of which could dramatically change the uranium market because it's so tiny. It's just a tiny space within an already tiny universe that we all operate in. Do you see generalists looking to lean in, Mark? And maybe this one for you because you're on the kind of the battery metal side. Do you see these generalists kind of looking in, buying into this kind of big thematic? And again, how do they value an entity like yours? How do they value companies and before they deploy capital? Because they need to deploy meaningful capital, don't they?
I think in terms of, the thing to watch for in terms of when the generalists come in is you'll see a cascade happening. So, if a metal or a sector all of a sudden sort of turns into favor, the first thing the generalists go for are the cash flow, the producers, right? and the big producers in that sector. Then you'll see them go into the into the higher torque developers, and then they'll eventually get down to the junior space. So the key piece there is you need to see that cascade happen. When I worked at Quadra 15 years ago, which was a copper company, I could tell when the hedge funds were rotating into copper, because you would see Freeport go. Once Freeport got going, if Quadra then took off, because we were the highest torque copper name in the space, then within a short period of time, you would start to see some of the better explorer developers start to catch a bit. But if you don't see them coming in those quote safe entry points, then you're that's the signpost to look for in a sector rotation. Because that's the part. I mean, when the generalists do come into the sector, because liquidity right now is so low that even a small amount of incremental capital causes the sector to pop. And if you get some of these bigger funds allocate even a smaller percentage more to this basic material sector, then it causes things to rip. I think we are a year or two away from that point. That we're starting to see tech companies, it's earnings season right now. Some of those companies aren't doing so well. And so this automatic, I just buy tech and I make 15% a year. That trade seems to maybe finally, falling down a little bit. And I think people are realizing that basic materials, we've underinvested now for the better part of a decade, that they are going to get a cyclical bid here. But again, I don't know whether that's going to be a year from now or 3 years from now. But that's the tricky part.
Okay. So I'm just conscious of time here, because you guys have got up early in the morning here. Just give me some of the simple ratios that you look at when you investigate, whether it be an exploration or developer. What are the actual data points that you look at? I get the macro. We've talked macro so far. Let's get into it. NPV per asset. How do you look at it, Dave?
When I'm looking at gold companies, and that's where I spend a lot of my time. I'm not a nickel expert, although I appreciate the scarcity of good nickel sulfide resources. So from time to time, I will come into names like Chalice, for instance, when they make their discovery, or Sirius. But unless it's a really exceptional drill hole, it doesn't work for me. So I guess when it comes to investing in gold and gold exploration names, 100 gram meter holes are sort of the staple of the industry. If somebody drills one of those out of nowhere, then you need to think about whether or not you're going to be a buyer of that. But you should only buy it if you look at the market cap of the company on the day, and if you believe that the average takeout value historically would still generate a multiple if the company is really on to something. So when I think about the gold industry, again, I think of the average takeout value for good discoveries over the last 2 decades as being around $500 million US. And if a $50 million company generates a 100 gram meter hole, then the chances that it can get to a $500 million valuation are at least in play. If it's already a multi-$100 million company and out of nowhere it drills a 100 gram meter hole, I'm less interested. I need a big margin of safety between the current valuation, where I think these things trade on average, and I really don't care that much about the other details when it's a new discovery. And it needs to be new. It can't be a new zone in something old. It has to be a new discovery. It has to offer a 10x multiplier from its current market cap to where things go out, and then I'll think about buying it.
Yeah, and I mean, for me, basically, has the team ever actually discovered anything? Has the team proven that they can raise money? To Dave's point, in terms of, is this a deposit that someone would actually want to buy? And again, even if you're not technical, go look to see if you can find a similar deposit and see what that might have been bought for. And if you can't find anything that hasn't been bought in the last 15 years, it's probably not going to be bought. And then, look to see whether, it could get to a scale of something that's, somebody might want to pick up just because of the scale of it. And if you can't answer those 4 questions, you shouldn't make it. To Dave's point, you want that margin of safety. If it's a 10% chance or a 10 bagger from there, again, go to the horse track. You got a 1 in 9 chance most races of winning, right? And that's a way better place to put money than gambling with
right. So those are the positive. Could I literally flip those on the head and say those would be the red flags?
Yeah.
Would that be a safer thing? Or are there any other scenarios where you think actually that restarts? Would you ignore those? How do you come at that?
Oh, I think a restart as a basically had someone who's had a successful one and watched a bunch of train wrecks happen. Beta Hunt, we bought it at the bottom at that when Dave's talking about that index bottoming at 470. We took our tiny little amount of cash and some stock and bought an asset that was a nickel restart at that point in time. Our theory of the deposit, though, was there was gold underneath that had been briefly mined and barely touched in the early 1980s, and realized, there was a gold mine sitting underneath this nickel deposit. We struggled through and undercapitalized, $10 million short for a long time, and we almost sold it before we hit the major thing, just because we didn't believe in the mine. We just couldn't raise that last $10 million worth of capital in that market. And so, again, if there's a clear theory as to what's different about the asset this time and a team that's got the technical base to be able to actually execute it, then do it. I mean, on the nickel side, Avebury is a mine that's failed twice. Someone just restarted it, and it failed literally within 6 months of restarting. There's other stuff in the gold space that's been a train wreck multiple times.
Mm-hmm. And I just say, and I just add to this. So assuming that we're at a capital low, we'll assume there are no generalists in the space. And I think that's fair to say at the moment. And of course, I'm talking about the junior end of the natural resource space. The very first thing they look for when they come back are things they can put values on. They need resources. They love restarts. Pure Gold was a darling of the industry because it was a restart in a venerated gold camp, Red Lake, where underground mines have a history of discovering new and highly profitable zones. It had great sponsorship with Anglo Gold, Shanty, and Arab Sprott as big investors, and it was candy for the generalist crowd as they were coming into the space at the time. I see no problem with investing prospectively in companies that have those attributes today, but that are not trading well.
Okay, well, gentlemen, we're a bit tight for time here, so I'm going to shut this conversation down for now. To intellectuals of the space I respect and like listening to, we maybe pick this up and maybe see what people are curious about another time. So thank you very much, gentlemen. Mark Selby of Canada Nickel, Dave Lotan, industry guru. Appreciate time today. Thank you very much.